Jeffrey Loria sold the Miami Marlins for approximately $1.2 billion in November 2017, exactly 5 years after Marlins Park opened, exactly 5 years after Miami-Dade County and the city of Miami completed the transfer of approximately $409 million in public financing, whose explicit justification was that the Marlins required a new stadium to remain viable in Miami, and exactly 5 years before anyone in Miami's public sector had a mechanism to share in the franchise value appreciation that the public financing had contributed to generating. The $409 million in public financing was structured through hotel tax revenue bonds and city capital funding. The total estimated debt service over 40 years is approximately $2.4 billion. Jeffrey Loria paid approximately $158 million for the franchise in 2002. He sold it for $1.2 billion in 2017. The public infrastructure that he occupied for 5 years between those two transactions helped produce the difference. That arithmetic is the forensic subject of this episode, not the stadium itself, which is a functional baseball facility, and not the Marlins organization, which is a functional baseball franchise, and not Derek Jeter, who bought the team from Loria and has managed a rebuilding period whose competitive trajectory is not the subject of this channel's analysis. The subject is the specific mechanism by which a professional sports franchise's relocation threat converts a municipal government's political calculus, the same calculus documented in case files 076 and 108, into a public financing obligation whose approved rationale was franchise retention, and whose actual financial consequence was franchise value appreciation that accrued entirely to the private owner. The mechanism is documented. The outcome is documented. The gap between the public investment's stated purpose and its actual financial consequence is measured precisely in the distance between $158 million and $1.2 billion. Subscribe now because the Miami Marlins case is the most precisely arithmetic demonstration of how sports franchise public financing actually works that this channel's archive contains. The Miami-Dade County Commission's approval of the Marlins Stadium financing in March 2009 proceeded through a sequence that the Commission members who voted for it have subsequently characterized differently than the Commission members who voted against it, but whose procedural record is less significant to this episode's forensic analysis than the specific financial structure the vote produced. The Marlins financing package was negotiated under the standard professional sports facility, public subsidy architecture documented in Case File 059's original treatment. The franchise presents a relocation threat. The public entity cannot credibly commit to allowing departure, and the negotiation produces a subsidy whose size reflects the political cost of departure rather than the economic return on the investment. What makes the Miami case forensically distinctive within that standard architecture is the speed of the franchise sale following the public subsidy's completion. 5 years is the minimum holding period that any competent professional sports franchise owner would observe before selling a team whose stadium had just opened, because the stadium's contribution to franchise value is most legible in the transaction price when the stadium is relatively new and the stadium-related revenue streams are performing at their projections. Loria waited exactly long enough for the stadium's contribution to franchise value to be fully priced by the market and then sold. That timing is not incriminating in any legal sense. Franchise owners are entitled to sell their franchises, and there is no document that obligated Loria to retain the Marlins for any specific period. But it is forensically specific in the sense that the 5-year gap between public subsidy completion and franchise sale is the interval that maximized the subsidy's contribution to the sale price, while minimizing any obligation that the timeline might have been seen to create. The specific financial mechanism by which the $409 million public subsidy contributed to the Marlins' $1.2 billion sale price is not fully separable from the broader factors that determine MLB franchise values, the league's national television contract revenues, the competitive balance tax implications of the franchise's market size, and the comparative transaction multiples that contemporaneous franchise sales established. What is separable is the counterfactual. A Miami Marlins franchise without a new stadium, playing at the aging Sun Life Stadium they shared with the Dolphins, in a market whose sports consumer demand for baseball had been insufficient to sustain consistent attendance at a stadium that was demonstrably inferior to the new standard, would not have sold for $1.2 billion in 2017. The stadium's contribution to the franchise value is not a precise figure that any available analytical methodology can calculate with confidence. What the available comparative transaction data suggests is that the stadium's presence as a new, baseball-specific, publicly subsidized facility with 30 years of remaining useful life contributed a franchise value premium of at minimum several $100 million above what the pre-stadium franchise would have commanded in a contemporaneous sale. Miami-Dade County and the City of Miami contributed $409 million to create that premium. They received from the premium $0 because there is no provision in the Marlins financing agreement or in any other professional sports franchise financing agreement in American history requiring the franchise owner to share franchise value appreciation with the public entity that contributed to generating it. The economic impact studies that supported the 2009 financing approval did not model this dynamic. They measured the anticipated economic activity attributable to the stadium's operations, the jobs, the hotel nights, the restaurant meals, the tax revenue, without modeling the private franchise value appreciation that the public infrastructure investment would contribute to generating. The 40-year debt service obligation that the $409 million public financing created is the specific financial instrument that distinguishes the Miami Marlins case from the conventional corporate real estate subsidy that this channel has documented in multiple case files. The public is not paying for the stadium construction. The public is paying for the bonds that financed the stadium construction across 40 years at an estimated total debt service of approximately $2.4 billion. This is not a public investment in the conventional sense. A public investment generates a public return. A $409 million investment at a 40-year bond structure that totals $2.4 billion in debt service generates a municipal obligation, not a municipal asset. The stadium is owned by Miami-Dade County. The Marlins lease it. The lease terms require the Marlins to pay operating costs but not debt service. The bond repayment is a county obligation serviced through hotel tax revenues and general city funds, not through the franchise's operating revenues. Miami-Dade County owns a baseball stadium. The baseball team that plays in it pays operating costs. The county services the debt. The former franchise owner sold the team for $1.2 billion and retains no connection to the obligation. The accounting of this transaction from the public's perspective is precise. $409 million contributed. $2.4 billion in debt service obligation created, $0 in franchise value appreciation received, and a 25,000-seat stadium available for the Miami Marlins use on terms that would not be acceptable in any commercial real estate transaction where both parties had equivalent bargaining power. The Miami Marlins case is the specific episode in this channel's archive that most precisely documents the financial mechanism that makes professional sports franchise public subsidies structurally different from other categories of public investment in private business activity. A public investment in a private company through a tax incentive, a grant, or a subsidized loan generates a public return when the company succeeds through job creation, tax revenue generation, and the economic activity that the company's operations produce. The public benefit is distributed across the economy that the company operates in. A public investment in a professional sports franchise's stadium generates a specific and concentrated benefit for the franchise owner, the franchise value appreciation that the stadium enables, without distributing any portion of that appreciation to the public investor. This is not a design flaw in the Marlins financing structure. It is the standard architecture of every professional sports stadium, public financing in American history. The Miami case is not an outlier. It is the model, the clearest available expression of what the standard architecture produces when the variables are filled in with the actual numbers. 158 million in, $1.2 billion out. The public provided the infrastructure in between. The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication.